So you've been working hard for years, hit your financial independence number early, and you're ready to get out of the 9-to-5 grind. However, you've been conditioned to believe that your 401k is untouchable until you reach 59 and a half years old. Touch that money early and the IRS will hit you with a 10% early withdrawal penalty. What if I told you there's a way to get around this that Fidelity, Vanguard, and Charles Schwab almost never discuss? And it isn't a shady loophole either. It's a legal IRS provision known as the Rule of 55. Today, I'll go over exactly what the Rule of 55 is, things to avoid that can instantly disqualify you, and the best way to make this work with your tax brackets. What exactly is the Rule of 55? It's an IRS tax code that says if you leave your job in or after the calendar year you turn 55, whether you quit, got fired, got laid off, or just decided to retire early, you can start taking withdrawals from that specific employer's 401k plan without incurring the 10% early withdrawal penalty. You're still going to pay ordinary income taxes on the money you take out, just like any other pre-tax retirement account, but the extra 10% penalty, gone. This is a game changer for those who want to retire in their mid-50s. Here's how this actually works. This is the most important part of the video because if you don't follow this exactly, it's game over. Step 1 is to make sure you leave your job in or after the calendar year you turn 55. For example, if you turn 55 in December 2027, you can retire anytime between January 1 and December 31 of that year. You don't have to wait until your actual 55th birthday to leave your job. You can legally resign, retire, or be laid off as early as January 1st of that very same year. Because the separation occurred within the calendar year of your 55th birthday, your compliance window is fully met. Step 2 is to keep your money in your current employer's 401k plan. The Rule of 55 applies exclusively to the retirement plan associated with your current employer that you're separating from. When you leave your company, the 401k administrator will send you a letter encouraging you to roll over your plan into a traditional IRA or Roth IRA. Don't do this. The very second your money leaves your current 401k plan, you've permanently blocked yourself from the Rule of 55. If you move your money to an IRA and then take funds from it, you'll be hit with the full 10% penalty. And the third and final step is to reach out to your 401k plan administrator and confirm if they can actually do this. Just because the Rule of 55 exists doesn't mean your 401k plan is legally forced to accommodate it. It's up to your company if they allow this option. Don't rely on what they tell you on the phone either. Many of them have never heard of the Rule 55. It might give you bad info. Trust, but verify. Log into your 401k portal and download the legal document called the Summary Plan Description, or SPD. Open this document and search for a section titled Separation from Service Distributions, Early Withdrawal Exceptions, or In-Service Distribution Options. The one question you need to find an answer for is this: does your plan allow for partial distributions after separating from your company at 55 plus? This must be yes, because if the plan states that separated employees are only allowed to take a single lump sum distribution, then the strategy is dead on arrival. Taking the entire amount out would instantly create a catastrophic tax event, pushing your income into high federal tax brackets and completely defeating the purpose of the strategy. I mentioned earlier that the Rule of 55 only applies to the 401k plan of the company you're leaving, but here's how you can maximize this with old 401k plans from previous companies you worked for. Under normal circumstances, those old 401k accounts are locked down until you turn 59 and a half years old. If you take money out from those legacy 401k plans, the Rule of 55 would not protect you. However, here's what you can do before you leave your current company. If your current 401k plan allows you to roll over your old plans, and most of the plans do allow it, then you can initiate a rollover, or in other words, transfer the assets out from your old 401k plans to your current one. By doing this, your entire consolidated balance now becomes eligible for penalty-free withdrawals under the Rule of 55. This simple move can instantly scale your accessible early retirement capital from a small fraction to 100% of your total pre-tax net worth. Now that we've covered the Rule of 55, let's talk about how to use this in a 3-bucket strategy. You want to do this to balance your cash needs against your tax liabilities. Bucket 1 is the Rule of 55 401k. This serves as your main income source between 55 and 59 and a half years old. Every dollar you take from this bucket avoids a 10% penalty. but remember that you're still on the hook for federal income tax. Bucket 2 is your taxable brokerage account. You should use this to help maintain your federal income tax bracket. If you only use your pre-tax 401k for all your living expenses, a big spending year could accidentally push you into a higher tax bracket. To manage this risk, only pull money from your 401k up to the top of your target tax bracket, and then use your taxable brokerage account to fund the rest of your lifestyle needs by selling long-term holdings, which are taxed at much more favorable capital gains rates. Bucket 3 is your Roth IRA. This is your safety net. While Roth IRA earnings cannot be touched penalty-free until you're 59 and a half, your original Roth IRA contributions can be withdrawn at any time for any reasons with 0 taxes and 0 penalties. Use this bucket as a last resort to allow it to grow tax-free as much as possible. Let's talk about healthcare, because it's probably one of the biggest monthly expenses you're going to have if you retire early. You won't be eligible for Medicare until you turn 65, so that leaves you with either COBRA or an ACA Affordable Care Act plan, which is commonly known as Obamacare. For most people, COBRA is too expensive because not only are you on the hook for what you used to pay when you worked for your employer, but you're also now responsible for what they contributed as well. What you paid may not have been a lot, but the company was likely paying 60 to 90% of the total cost. And it's not just 100% of the premium, but there's also a 2% admin fee that gets added on top of that amount. The price of an ACA plan, on the other hand, is subsidized based on your income. Premium tax credits are available if your household income falls between 100 and 400% of the federal poverty level. For a single individual in 2026, 100% is $15,960 and 400% is $63,840. Full price ACA plans for a 55-year-old typically cost between $500 and $1,200 per month before any subsidies. The exact costs depend on your age, income, the state you reside in, and the chosen health plan tier, bronze, silver, or gold. If you time your early retirement withdrawals carefully, you can lower your taxable income and get really affordable monthly premiums. If you qualify for an advanced premium tax credit based on your estimated annual income, your actual monthly payment can drop significantly. Sometimes it's $0 for bronze or low hundreds for silver plans. So please figure this out before you retire and budget some money for an ACA plan until you reach Medicare age at 65. You can estimate exact local numbers using the ACA subsidy calculator I included in the video description. Here's one last tip, one last gold nugget about the rule of 55. If you're a public safety worker, like a police officer, firefighter, and emergency responder, you're able to take advantage of the rule of 55 at age 50, 5 years earlier than other workers.